Get a move on, and a whole host of numbers that came out yesterday. Eicher Motors among the lot, and the lockdown clearly hit its quarterly show, and margins as well slumped quite significantly. Karanya is here to walk us through the report card and tell us how Eicher Motors fared in Q1. Karanya.
It's been a weak set from Eicher Motors for the quarter gone by. Their loss and EBITDA performance has come in below par, below what the ET Now poll was estimating. Revenues were in line, but on the EBITDA front, they barely managed to break even, with EBITDA coming in at just about 3.8 crores, leading to a margins performance of just 0.5% compared to 25.8% YOY. This is the same company that's used to delivering high double-digit growth, which has come down crashing to 0.5%. Of course, the unprecedented circumstances that threw up because of COVID-led disruption is something that is largely responsible for this kind of weak performance. But their commentary on Royal Enfield has been quite encouraging. Bookings are almost back to pre-COVID level. Inquiries are better than the pre-COVID levels. In fact, demand they say has sustained very strongly over the last 6 to 8 weeks. So the management has said it's not just pent-up demand. They expect it to continue going forward as well. Of course, the caveat here is that there shouldn't be more intermittent lockdowns across the country. They have over 90% of their dealerships open. Supply chain has been the biggest bottleneck for them because of lockdown. In key supplier areas like Pune, Aurangabad, Chennai, they could have easily done better by 20-25% in July had it not been for the supply issues. They have an order backlog of about 40-45,000 units. Inventory is just at 10,000 across dealers. Ideally, it should be worth 3 weeks, which is currently at 1 week. So this is the commentary on Royal Enfield. Quite encouraging. VECV business continues to trail. It'll take some more time, some more quarters to pick up, but numbers, just looking at the headline performance, it's definitely a weak set.
Okay, thanks for that. But Karanya, there was also a disappointing set of numbers from Hero MotoCorp. Walk us through what they delivered, because you did see their margins come in quite significantly lower and profits took a big knock.
As far as the verdict goes, Hero Motors Q1 has been a tad bit on the disappointing side. Profits as well as margins both have come significantly below our expectations. Of course, we were factoring in the fact that the quarter gone by was unprecedented in many ways. There was a lot of turbulence, a lot of disruption seen. But the numbers they've delivered right now, looking at the revenue, it is better than estimates, 2,971.5 crores versus 8,030 crores on a YY basis, clearly reflecting the kind of volume drop as well that the company has seen. Profits came in at 61 crores, down almost 95% YOY. EBITDA came in at 108.1 crores. Margins have come in at 3.6% versus 14.4%. Like I said, we were expecting margins slightly above 4%, 4.3% to be exact, but they've delivered it at only 3.6%. So I am not sure how happy Street will be with this kind of a performance on the operating front and the bottom line figure. But the commentary has been cautiously optimistic. They're seeing sequential pickup in sales. They've started witnessing it Q1 onwards, and that continues to be the trend. They're working on cost control and increasing efficiency, which has helped them offset the impact of COVID as well. Cash conservation effects, rationalization of expenses, productivity enhancement, these are the things that is cushioning their performance and the pain caused by COVID. July sales are over 95% of pre-COVID sales, and they see positive trend going forward as well.
All right, so that's a stock to keep an eye out on. But let's drive away from auto and focus in on metals. It was Tata Steel that delivered a mammoth loss in the quarter gone by. Let's find out the kind of disruptions, what their operational parameters were as well. Mubina joins in to give us a snapshot. Mubina.
It's the third straight quarter of losses for Tata Steel, and of course in Q1 there was significant pressure on volumes, on deliveries, on prices because of the lockdown. So overall losses, or rather loss attributable to shareholders, came in much wider than the ET in our poll at 4,373 crores. Revenues was more or less in line at 24,289 crores, and EBITDA barely passed the muster at 597 crores, leading to margins of 2.5%. The India business is once again something that provided some support. We had the EBITDA per ton over there coming in at 4,969 rupees per ton, despite the fact that the volumes crashed by almost 26%. Of course, that did lead to the company unable to absorb 2,000 crore rupees of costs because of the whole negative operating leverage bit. But Europe was really the key pressure point yet again. The company has said that because of the lower deliveries and the massive compression in steel spreads to a level that is now unsustainable, I think the European operations have suffered quite a bit, dragging the consolidated EBITDA as well. They did say, though, that they did receive some funding from the UK and Netherlands governments, including cash flow deferrals of payables. However, despite the miss on the EBITDA and the bottom line, the company has managed to keep their net debt levels stable, largely on a sequential basis. So India business net debt has actually reduced by 1,700 crores. Plus, the company has raised some money to sort of extend their maturity profile. And anticipating challenges as well, the company has built up a liquidity buffer of 20,000 crores. Now, what's interesting is the management has said that as domestic demand improves, their exports will reduce. Prices as well are showing a positive trend on a sequential and on a month-on-month basis. Furthermore, the management says that they are cautiously optimistic that the worst is behind them. Morgan Stanley, too, has noted the fact that while operationally it's a miss, the fact that they brought down net debt levels or kept them stable is a positive. They have their target at 435 rupees.
All right. Thanks very much, Mubina, for giving us all those details. Let's take a quick break. Come right back for lots more.